I'm Steve from Clearly Training, and this is one in our series of Finance for Non-Finance People courses. And this course is all about budgets and budgeting. So it's aimed at non-accountants who want to understand the budgeting process, who want to understand what budgets are all about, and who want to appreciate what all the terminology that accountants use when they talk about budgets actually means. So if you're a non-accountant and you work in a business and you're involved in budgeting, or if you're a business owner and you want to know more about how to create budgets, then this video is for you. And I've split it into two parts. So let's have a look at what's in this two-part Finance for Non-Finance People, all about budgeting for non-finance people. Let's have a look at it now. So I'm all about the idea that finance videos aren't the most interesting in the world. I'll try and keep your attention the best I can, but one of the ways of doing that is to split the course into two shorter parts. So here are the two parts. Part one, I'm going to look at an introduction to budgeting, what budgeting is all about, why we have budgets in the first place. And then I'm going to have a look at the strategic aspects of budgeting. So, that gives you a bit of background as to what the budget is adding to the strategy of the organization and how it's helping to achieve the strategy of the organization. And then I'm going to look at the basics of what people want from a budget. And really, although we budget for a whole range of different financial statements, the key financial statement that we're looking at is the profit and loss account, the budget for the profit and loss account. And in that, I want to look at something called cost behavior. And that's all about understanding how different categories of costs behave when we prepare the budget. And if we understand that, it helps us produce a better, more accurate budget. Then in part two, I'm going to look at the actual preparation of the budget itself, step by step, how organizations go through the budget preparation process. Then I'm going to look at an actual example. So unfortunately, it's going to be a spreadsheet that I'm going to show you on the screen to see what a real budget looks like and what the pro formas are like. And that's actually a good lead into one of our other videos, which is on management accounting. So watch out for that one as well. Anyway, more on that later. Then I'm going to look at the role of the manager or the business owner, how you might get involved with the preparation of the budget and how you might interact or be asked to interact with the finance team if you've got an internal team or your external accountants if they're preparing the budget for you. And then I'm going to look at something which is quite frustrating in practice, the way that budgets tend to bounce around. In other words, the fact that you might prepare your budget, submit it to finance, then it comes back to you and then goes back up again and comes down again and so on. And it just seems to bounce around. It can be quite frustrating for managers. And I want to explain why that happens and what the organization is doing when that is happening. So that's our two-part course. We're going to make a start now with our introduction to why we have budgets. So I would say there are 5 reasons why we have a budget. The first reason is that we want a budget so we can predict what next year, that's next financial year, will look like. So I'm going to use some examples here, and I'm going to assume that our business that we're thinking about has got a financial year that starts on the 1st of January and ends on the 31st of December. Remember, a business can pick whatever year end it wants, but I'm going to pick 1st of January to 31st of December. So let's say we're thinking about 2023. And we're in 2023 in my example, and let's say it's getting to around September. So we're getting around towards the end of the year, towards the end of 2023. What we might start to do when we get towards the end of 2023 is we might start to think about, well, what's going to happen in 2024? So we might start to make our budget for 2024 sometime around the end of 2023. So we start putting that prediction of 2024 together around about the end of 2023. It might be in September, it might be in July, it might be as late as November. But we need to do it. We need to get our budget together and finalized before we start on the 1st of January in 2024. And if we do that, then we've got a plan for 2024. We're warned about what's going to happen in 2024 if we start to think about it later on in 2023. Once we've got our budget, once we've got that plan, that financial plan together, then we're able to compare what actually happens in 2024 with our 2024 plan, our 2024 budget. So For example, if we've got a budget for the 2024 year end, what we can do is we can split it down into 12 months. So we might do that on a phased basis, realistically looking at what's going to happen in January, splitting our budget down into roughly a 12th, and then we'll have a budget for January and a budget for February and March and so on for every month of the year. And then when we get to the end of January 2024 and we've got our actual performance, we can work out our actual performance and we can compare it to our budget performance. Now, when I talk about the performance, and this is something really important when we think about budgeting, I'm actually talking about our profit and loss account performance. Because although we'll prepare budgets for the profit and loss account and the cash flow of the organization and even the balance sheet of the organization, possibly, the real thing that we're interested in when we talk about budgets, the key thing is the profit and loss account budget. When people use the term the budget, they really mean the profit and loss account budget. Okay, yeah, the cash flow budget is very important as well, but that will be driven by our profit and loss account budget. So sometimes people use the budget when they just mean the profit and loss account budget. This is what I'm talking about here. When I'm talking about our performance, I'm talking about our profit and loss account budget. The third thing is that preparing a budget is a good way of briefing our funders. Now, in some organizations, the businesses are owner managed. Even then, the owner will want to know how well the business is going to do in the next year. The owner will want a prediction. It may very well be that the owner prepares that prediction themselves, or they get their accountants to help them with it. In a larger organization, though, we're often got the case where the people running the business, the directors, are not the same people as those who own the business, the shareholders, or the directors might have some shares, but they haven't got all of the shares. So by preparing a budget for the following year, using my 2023-2024 example, when we're in 2023, towards the end of the year, when the budget's finalized sometime around November, December, the directors can go to the shareholders and they can say, look, this is what we think we're going to achieve next year. And the shareholders can then decide whether they think that's good enough. The shareholders might decide, oh, well, that doesn't look very good. You need to rethink your plans, or we might need to get some new directors. And also, you might have to brief the banks, the people who are lending you money. They are funders as well. They'll want to know how much you're going to make next year so they can see whether you can meet your interest and capital repayment commitments. Okay, so that's the third reason. The fourth reason is that by having a budget, it might help us spot errors in our accounting. So again, using my example, if we get into 2024 and we're actually, let's say in March 2024, so we've had January, February, March, and we've compared our actual performance against our budget performance for those first 3 months, if we're significantly different to our budget performance, it could mean one of two things. It could mean that the budget was wrong, or the budget was misforecast, or it could mean that our accounting is wrong, that there are errors or even illegalities, frauds going on in the business. And having a budget, having a plan to work to that we think is accurate, helps us to spot those errors. And lastly, and again, this sort of ties into the last point and a couple of the other points as well, a budget is a means of control. It's a plan. And plans are there so that you can control how you work towards that plan. You know, what happens in January when you compare January's actual performance to January's budget performance is you might find they are significantly different. And it might not be that there's any errors. It might be that something's just going wrong. And so you need to actually bring things back on track. And having a budget and regularly checking against that budget. It's not just having the budget that's important. It's that once you've got it, you keep referencing it, you keep checking it. By constantly checking it, it helps you control the performance of your business. So in most organizations, larger organizations in particular, there will be a strategy for the business. And the strategy is a longer-term plan. So that plan might be over 3 years, 4 years, 5 years, sometimes even longer. I'm going to use in the example a 3-year strategic planning period. So let's say a business has got a strategic planning period of 3 years. So it's got a strategy that it wants to achieve over those 3 years. And strategies will have all sorts of elements to them. But you know what? The key thing that the business is going to try and achieve with a strategy is to increase its profitability. That's always got to be at the heart of the strategy if you're a commercial business. So the business will have strategic aims. They will usually be financial. There will be other things going on as well, but that financial aim will be crucial. And of course, the budget is a financial plan. So let's say we've got a strategy going on over 3 years. The budgets will be prepared to help us implement the strategy. So what will happen is you'll have your 3-year strategic plan, and you'll then start to think, well, okay, what are our aims by the end of this 3-year period? What are we aiming for in terms of our total level of profitability with all of the things that we're going to do, all of the new operating locations that we're going to open, all the new training that we're going to put on, all the new staff that we're going to recruit? Okay, what's that going to look like in financial terms? And what we can do is we can use summary budgets for each of those 3 years to help us think about what's going to happen financially in year 1, what's going to happen financially in year 2, what's going to happen financially in year 3. And that helps us keep our strategy on track. So what we'll do is we'll break the strategic plan down into individual years, and then we'll start to think, not in detail, not in the great, minutiae of detail that we'll get in a full annual budget, but in overview. What's our revenue going to look like, for example? What are our operating profits going to look like? And we'll break that strategy down into manageable chunks. And that'll help us manage the budget, or help us manage through that strategic planning period. So if I look at it in overview, let's say we've got a 3-year strategy up there on the screen. And what we're aiming to do with that 3-year strategy, we've got all sorts of elements to it. I don't just want to get you to think that a strategy is just about the money. There'll be lots of things that feed into that, but our overall objective is to make sure that by the end of year 3, we've got this ability to earn profits going forward of at least 10 million each year. So what we'll do with our strategy, because as I said, there'll be lots of things to it, almost certainly in the first year of the strategy, and possibly the second and third as well, there will be investments to be made, there'll be money to be spent. Often we will end up losing money or making less money when we start a new strategy than what we're currently making. So let's say we sort of plan this out in overview through our budgeting process, and we say, look, in year 1, what's going to happen is we're actually going to lose money because of all the investments, all the training, all the extra resources, all the new businesses we're opening, all the new locations and so on. Lots of things not quite working in year 1. So we'll lose money in year 1. And then in year 2, we'll start to make something. Not as much as we want to make, as you can see there. Not as much as the 10 million sustainable profits, but we will acquire a significant number, 10,000 new customers. And then we move on to year 3. And look what's happening in year 3. Over 12 million profits. That will ensure that we'll meet that 10 million sustainable profits going forward. 30,000 new customers. Fantastic. That's how the budgets will keep us on track. And then what we'll have each of those 3 years, when we come to do the detailed budget for year 1 and the detailed budget for year 2 and the detailed budget for year 3, we'll have those outline profit and revenue figures already there. So we'll know when we start preparing our budget in detail what we're working towards. And we'll talk more about that later and actually finish. We'll come back to this point right at the end of the second video. Let's move on.